The US Treasury's buyback program, which began in earnest in April 2024, is having a more significant impact on the bond market than many analysts expected. Traditionally, the scale of Treasury buybacks was considered insignificant compared to the vast size of U.S. marketable debt, now around $29 trillion. However, recent data shows a different picture. In Q2 2025, dealers purchased about $145 billion in long-term treasuries at auction, while buybacks during the same period reached $69 billion, almost half of what dealers took down. This marks a substantial increase in the importance of buybacks, particularly for dealer liquidity. Buybacks allow the Treasury to repurchase long-term bonds from dealers before maturity, providing them with fresh liquidity. The process is conducted via competitive bidding, so the actual amount repurchased is sometimes less than the maximum announced, depending on the price offered by the Treasury. What's notable is that since the buyback program began, the volume of bonds dealers are purchasing at regular auctions has declined. This suggests the buyback program is directly influencing dealer participation and their willingness to take on new inventory. Another important point is the source of funds for buybacks. Since the U.S. is running a fiscal deficit, the Treasury is funding buybacks by issuing more short-term debt. For example, if the Treasury planned to issue $500 billion in short-term bills, it might increase that to $600 billion and use the extra $100 billion to buy back long-term bonds. The market's focus now shifts to the upcoming Quarterly Refunding Announcement, QRA, on July 30th. This event will reveal the Treasury's updated plans for long-term issuance and buybacks. Any change in these plans could have a meaningful impact on bond yields and overall market sentiment. As a result, market participants are closely watching for signals of a shift in Treasury strategy.